And now it's my privilege to welcome a very special guest. The story of Iceland was very much in the discussion of the previous panel. Please correct me if I'm wrong, but the country had a banking sector of about 10 times GDP. The main 3 banks of Iceland were nationalized during the crisis. And today, to share a great experience with us, we have with us Dr. Svein Harald Øygard, who is a prominent economist, who has been the head of the Central Bank of Iceland, although he's from Norway. And that was in 2009. And he was, of course, in the midst of this very difficult crisis that was brilliantly managed. And I'm sure that we're going to hear about this experience in the coming minutes. I would also like to flag that he is the author of a book called The Combat Zone of Finance. I don't know if it's already available in English and Chinese. It is already available in English and Chinese. That was supposed to happen in 2020. And it's my mistake that I'm not sure about that yet. He previously worked for McKinsey. I'm going to leave the rest of the bio to our friend Johnny, but please give him a warm welcome. He's in Lebanon in very tough days, and we are very honored to have him with us. If I'm not wrong, also you've been involved in ministerial and parliamentarian works in your career. So we are very eager to listen to you. Thank you very much, and welcome.
Thank you. Welcome, Mr. Harald.
When you have an economic crisis, first you have to clean the floor, right? So I have to throw away the past, all the chairs, and then we go into the future. So, I said I was the central bank governor of Iceland after the crash, which is a very important distinction. And I was called upon by the Icelandic government to help in the first part of the change process. Of course, first, as an author, I have to do some marketing. This is my brilliant book. It can be bought at Amazon. It's highly recommended. It's basically the story of how a country can go from the deepest crisis into transition, into the fastest recovery of all crisis nations. So I think it should be of some relevance, even though every story of every crisis, of course, is different. To place this a bit in context, as an economist, of course, I run the big database of all economic declines measured in US GDP, sort of converted, of the last 10 years. Of all 196 countries in the world. So basically, this is the GDP decline, minus 54%, Macau, Libya, minus 53%, Venezuela, complete meltdown, minus 48%, and Lebanon on a less so honorable 4th place as the deepest crisis measured by this metric. And then you go on with countries that you really not want to be compared with. And then I added as a reference Iceland, that had, before I came, had a decline of 39% of GDP measured in dollar equivalent. And it was the largest decline, actually, of all countries globally after the global financial crisis. So this is a spaghetti chart. So basically, it shows, supposedly, what happened with the GDP of some of the crisis countries. And I'll go through a couple of the points. It's all indexed, and it's indexed up against the peak GDP value, which is then 100. So if I get the colors right, this is then Lebanon, the orange part, and it goes on, reaches 100, which is the peak GDP, and drops, as I just mentioned. And then, where do we go from there on? Of course, that's the topic after this discussion. Then you see a couple of examples. One example is the countries that do not recover. And why don't they recover? Well, basically because they end up in a systemic crisis. And the ultimate example there is actually one of the richest countries in the world in the 1930s that basically broke down the software of the economy by messing up the pricing system, plus sanctions and a lot of infighting, almost civil war, and then ended up bringing Venezuela from a prominent position among the richest countries in the world to a very horrendous situation as one of the poorest countries in South America. A European example is this one, basically Greece going up and then peaking at close to the before the global financial crisis. Then Greece crashed, wasn't able to solve its structural problems, believed that the outside world will help them, and ended up in a 10-year discussion on who should pay the bill, with the result that they didn't really address the underlying problems of the Greece economy. And where is Greece now? It's at half the value that it had pre-crisis. Then, of course, since I'm here, this is Iceland, climbed up to 2008, peaked, crashed almost 50%, and then climbed steadily over the coming years, had a new decline post-COVID, before it then basically came back to a prominent position among one of the 10 richest countries of the world. Argentina, just to complete the story, ups and down and bumpy, but still almost making it. Ukraine, the pink, basically collapsed after the 2014 invasion by Russia, then steadily bringing everything back in order before they again were attacked by Russia, with the result the GDP decline. So if you want to look at cases, this is just a catalog of cases. It's an example of what goes wrong in countries that really don't address the key issues and what can be done if things are handled in a good way. Yeah. So just a few words about Iceland. It's not because it's a good parallel, but it's sort of some references here that are important. And of course, it is one of the points that I had. Iceland was also on an IMF program. A couple of you have mentioned it. Fewer than what I would thought, actually, given the importance that this will have in shaping the direction of your country. So I'm a bit surprised, actually, by that, to the degree that this hasn't reached the top of mind of such an insightful audience. That will change, believe me. So this is what shortly was happening in Iceland. Iceland attracted money from all over the world into a small country, smaller than Lebanon. I drew it a bit bigger here just to give the right size. And how did they do it? Basically, they went out in the international capital market and said, come with your money to Iceland, and you get a slightly higher interest rates that you have in your home countries. So first they tapped into the European market, and then into the US market, and then the Asian markets. And this was largely financing from banks, international banks, that went to the 3 Icelandic banks. So the 3 Icelandic banks basically became some of the largest banks in the Nordic. So as mentioned here, I think the number I use is that the balance sheets of the banks ended up being 12 times the size of the GDP. So basically they beat the heck out of Lebanon that only got to 5. So there are basically people that have run a larger Ponzi schemes than yourself, and that basically made it. So the money went to Iceland, 12 times GDP. Simplistically, 7 times GDP went out again into the world. It was lended out by the 3 banks to international clients. 3 times GDP is a humongous amount of money. 3 years total income was basically distributed out into the Icelandic economy as loans to Icelandic companies and households that became the most indebted companies and households in the world as percent of GDP. And a lot of that was actually foreign currency loans, because the Icelandic currency rose and rose in value. So people thought it was very inexpensive to have a foreign currency loan up to a certain point of time. So the most indebted households and companies in the world, and the largest banking sector in the world, and the world has never ever seen something similar. To say it briefly, a bit different from here, at least from the last introduction. I learned that here was different. The Lebanese banks went out to the world and offered a high interest rates. The money came to Lebanon, and then it went into the local banks, and they sent it to the central bank. And the central bank basically ended up being the bad guy in the history. And the central bank then sent on the money to the government in substitution for the government's inability to raise taxes from its people. And why couldn't it raise taxes? Well, most probably because of lack of political legitimacy. So the story then is a story of lack of political legitimacy, a desire to spend more money than you have, a government that runs a deficit, a central bank that pays for the deficit, the banks that provide the money to cover the deficit, the interest rates used as the tool to get the money, and the international sources of capital, and the poor Lebanese that have made their deposits being the ones that actually finances what's really rooted in the problems discussed yesterday, linked to lack of political legitimacy. This is just a 1 minute economic political analysis from me sitting here all day yesterday and today, trying to understand what the heck has been going on. So hopefully I got it reasonably right. Okay, back to Iceland. So this is what happened. So this is the total debt of Icelandic companies and households as percent of GDP. So basically, the money went into the country, into the banks, and it was then distributed out into the economy. As some economists in the room will know, when you inject this amount of money into the economy, you get a super boom. In the equity market, in the housing market, regarding unemployment, everyone thinks this is a really good ride. So who can you blame? Well, you can also blame the people, because the people had a really good time. And you can blame the policymakers, because it was a very convenient couple of years. But then, of course, like everything, nothing grows into heaven, not even debt. So at some point of time, the capital market says, okay, what's going on? They did not want to provide more capital to the Icelandic banks, as they didn't to Lebanon, and then everything crashed. In Iceland, everything crashed in a week in October 2008. 90% of the banks went bankrupt. Unemployment went through the roof, and so on and so. But again, this is the interesting part of the story. You could also say, I guess, also equally interesting, this is the other part of the story, that they were able to get rid of the debt. So it's one thing is to get debt. That can be hard, but what's really difficult, of course, is to get rid of the debt. And maybe that's something where you also could learn from Iceland. But then you, of course, definitely need to read my book. Okay, so what happened in financial markets? Well, when money gets into the system, where the same money chases for the same targets, valuation goes through the roof. Property values, equity values, and so on. So this is the evaluation of the Icelandic equity market. And as you can see, some people had a really good ride here. And I guess this goes under the embezzlement part, as mentioned in the presentation yesterday. Before the market firstly lost its trust here, then it came back, and then everything collapsed with a 95% reduction of equity values. The same happened to property values and so on. So what we saw in this tiny country was 3 of the largest defaults ever in the history of mankind. So this is on the left-hand side. These are all the defaults, bankruptcies, to put it that way, by companies that have been rated by one of the rating agencies, by Moody's. So basically on the top you have Lehman Brothers, as many have heard about, WorldCom, And on the 4th place, Kaupthing, one of the Icelandic banks. On 6th place, Glitnir, another Icelandic bank. And these are the bankruptcies in the global financial crisis. The 10 largest bankruptcies. And the one Icelandic bank is on the 2nd place, one is in the 3rd place, and one in the 7th place. And I don't think any Lebanese banks will make it on any of these lists, despite the magnitude of your crisis. And then, of course, also here, there were sort of riots in the street, and this is the flag of one of the banks being, basically demonstrators putting light to the flag. Another part here is also the default volumes. So these are the magnitude of the securities, basically debt obligations of these banks in the capital market that were defaulted. So it's $12 billion here, 18 here, and 20 here. So basically $50 billion is of defaulted bank debt in this structure. And this is what the capital market expected that they would get back, 3%. So basically, the day after the collapse, you could buy back the debt given to the banks for 3% of the face value. And yes, all these banks were restructured. Part of them went bankrupt, went into the bankruptcy process. The debt was bought by the hedge funds, and some were able to sell it not at 3%, but at 30%. So they made a 10 times return by being the vultures in this story. So to just wrap up quite quickly, this is some of the things that happened. 90% of the banking system collapsed in a week. The households and the companies went bankrupt, a large part of them. Half the companies in the countries went bankrupt, which I think is even worse than here. And that was caused given the high indebtedness and the high level of foreign currency loans among the debtors. The payments were basically, the central bank had to take over the credit card payments. The banks, when they collapsed, they get funding from the central bank, and then they eventually still collapse, and the central bank takes control of the assets. We were chased by 60 international creditors who had given money to the countries, and we ended up in a dispute with the UK and the Netherlands. And it went to the point where the UK basically prohibited transfer of funds to Iceland, but they had no law that could hinder it. So what did the UK did? Well, they basically had a list of countries to whom you could not transfer money, which included Al-Qaeda, Belarus, Burma, and so on. But they simply then put Iceland on the list of terror organizations to block any transfer of funds out from the UK to Iceland. So this is the central bank, the reception in the central bank before I came. No one had really told me that this is what would happen when I came, but still, we had to take it from there. Also here, in banking, there's also a question of legality, there's a question of politics, and there's a question of practices. And many would say that some of the practices in these banks were, so to say, well above on the other side. This is basically, in Iceland, all the bank secrecy laws were lifted post the collapse. So everything was made public. The entire loan book of the bank, the complete list of people that had borrowed money to the banks. I got a spreadsheet with 40,000 lines when I wrote my book, which is basically the list of all the creditors that have given money to the banks. But it also included the list of who had borrowed money from the banks and basically taken out money from the banks. And they hadn't done it as these guys up in the right-hand corner, the normal bank robbers. No, they had basically borrowed from themselves. So the bank owner had borrowed from their own bank. So this is the largest owner of Glitnir, one of the banks. This is his mother, this is his father, and this is his wife. So 4 of the 10 largest lenders in one of the 10 largest banks, 4 out of the 10 largest lenders in one of the 3 Icelandic banks, which were among the largest banks in the world, were basically the owner, his wife, his father, and his mother. And I don't think you have that in Lebanon, because here I think it went to the central bank. But who knows? You keep it secret while this was revealed. So what happened? Well, in Iceland, after the global financial crisis, the UK, Japan, and Korea jailed 0 bankers. The US, where the whole crisis originated, they jailed 1 banker. And little Iceland jailed 25 of the 47 bankers that were jailed globally after the financial crash. And this is the Icelandic jail. It's not a comfortable Mediterranean climate, that's for sure. Okay, let's get to the even more serious part. This guy, because he was in Iceland, when I came to Beirut, I think Sunday evening, I was actually quite pleased, or I don't know, surprised, because I saw you still had a McDonald's store on the corner. Well, what happened in Iceland was that pre-crisis, the currency, now all the students in macroeconomics had to follow here, because it's a good case example. So pre-crisis, the currency was strong because of the capital inflow. So basically, McDonald's could establish a franchise whereby they could import bread from Germany, meat from New Zealand, and so salad from UK, and then they could make it all in Iceland. Then, of course, when the economy crashed, the currency crashed, the McDonald's went out of business, which still hasn't happened in Lebanon. And it was all substituted by a new chain called Metro, basically with local meat, local bread, local salad, and that, of course, helped to reduce the import substitution and helped to bring the macroeconomic conditions back in good order. So a lot is still to happen, I think, in Lebanon. So we also then had an IMF program, and I tried to summarize everything on 1 page. I won't go through the detail, but just show some points, because on the next page, I made a similar page for Lebanon. And my idea was that to focus the debate, it is important to really identify the few critical things that need to happen. And I must say, and I'm going to criticize this grouping a bit, because I've hardly seen ever such an unfocused group of people. All of you believe different things are the most important thing in the world. And you all believe that a state that hasn't been able to manage even the most simple things in a country of entrepreneurs now should be given the responsibility to bring things back in order, which sounds a bit puzzling to me. But I will leave that for the debate afterwards. Anyway, so we said that the macroeconomy had to be fixed, the monetary policy had to be fixed, the fiscal policy had to be brought in order, and of course the banks had to be restructured. And we put out a timeline saying that all this stuff should be done in 1.5 years. It's not really that conceptually difficult. You just need to decide and execute. Take out the inflationary pressure, address the export challenge, re-establish stability on the exchange rate, solve the budget issues, negotiate the claims regarding the banks, refinancing banks. What you get a fully operational banking system, you get clarity of state debt, and then you basically create a growth momentum for the country. So, looking at the IMF program, this is my 1-pager for Lebanon. So, the same categories. It is more different than what you thought, but it is some of the main elements. There's something on the macroeconomic, something on the monetary policy, something on the way your budget is structured, and then, of course, something on the financial markets. I'll go through it in some detail, and then I will dwell on a couple of points in the next pages. So, on the macroeconomy, it was mentioned, twin deficits. Okay, so basically, Lebanon as a country spent more money on imports than you were able to earn on your exports. And how do you close the gap? By more borrowing money. That's one of the 2 deficits. The second deficit, the government wasn't able to raise money And the government normally just raised money in one way, by taxes. So the government was not able to tax the people in the room in a fair way that was sufficient to pay for the cost of running the government. Social schemes, corruption, all the other stuff that the governments had to spend money on. So there were the two twin deficits. And they were both covered in the same way, from what I understood, by basically more borrowing money from abroad and from Lebanese citizens. And that was done by high interest rates. So those two deficits have to be fixed. The first of them, the macro balance, has been touched upon earlier today. How do you fix it? Well, you fix it by reducing imports and increasing exports. And increasing exports means, of course, for example, more tourism. Reducing imports means import substitution. I haven't seen the numbers, but of course, as a country goes into contraction, as Lebanon, most often that reduces consumption dramatically, not least with what has happened to the currency. So I wouldn't be surprised if this actually has been fixed already, simply because of the status of the economy. And that was also what happened in Iceland, but I'll get back to that. Then, on the fiscal policy, and I'll get back to the monetary policy, but on fiscal policy, of course, the second deficit also needs to disappear. And as touched upon yesterday, okay, that means a change tax reform. And of course, that has to be rooted in political legitimacy, because it's hard for a government that isn't legitimate to tax its people. So what do? They pretend. And how do they pretend? Well, by borrowing money from the central bank, or even worse, by printing a bit more money in the central bank than what's collected from the public. And if you print more money, that's basically a tax, but it's an inflation tax. And that's one of the other things that was happening in Lebanon. So tax reform, increased import taxes, and spending cuts to the extent that's possible. And then, as IMF said, the government debt needs to be restructured, which basically means some people that have borrowed money to the government needs to forget about that money. And of course, you need to reform the state-owned enterprises, especially in energy, that's been running in a deficit. And then the banks, and I'll get back to the banks, they will need to be also restructured. 14 out of 14 banks was mentioned by the last speaker, scaling and so on. With that, you can get banks that support the domestic economy, which is what any economy needs to grow. You need to slash the public deficit to 4%, is what the IMF says. And then, last but not least, the monetary policy needs to be fixed. And what can you expect? Well, the first thing, the money printing, as I said, has to stop. Because if you print money, then you will have inflation. And if you get the inflation, then of course, at some point in time, it goes out of control. I think you have to expect high interest rates as part of it. And most probably, it's written a bit between the lines in the IMF paper, but there will be capital controls. So basically, there will be limitations on the ability to exchange your local currency into foreign currency, and going to one currency rates. And then at a longer term, at some point of time, this whole thing needs to be rebased, which means either you get an inflation target, and if you get an inflation target, well, that has to be rooted in the stronger fundamentals. It has to be rooted, most probably, in the injection of capital, and kind of a political legitimacy. You can have a link to a currency, but of course that's only legitimate if you have all the things above. Or you can just scrap the whole local currency. There are countries who have done it. Montenegro in Europe uses the euro, and Ecuador in South America uses the dollar. And they basically forgot about the whole thing of having a currency. Again, a small country with entrepreneurs and a country that can't solve even the basic stuff. Yeah, can it even have a currency? Just to be provoking. Anyway, with this, as long as you have entrepreneurs, willingness to work, innovation, well, things can be solved. So then there are a couple of things to note along the way. In this recession, how would you avoid that everything stops? And I think one of you guys also made a reference this morning to the IMF program. And I think one thing you need to remember, the IMF program is not about the money. So there's an expectation that as part of the IMF program, they put $3 billion on the table. And there's a expectation that in addition, there are friendly countries, sponsors, whatever, that will put additional money on the table. But here you will be disappointed. The money from the IMF is not money that's given for charity. It's not even the carrot, it's the whip. It's the whip that forces a country to do what the country is obliged to do or should do in the view of IMF. So forget about the money. Remember the list that I just showed you, which is basically the wish list of IMF that will be forced down your throat, whether you like it or not, as long as this is the journey that you're embarking upon. And I had the pleasure in Iceland working with IMF, and I'll get back to that shortly. Anyway, how do you avoid the economy from stopping? There's one piece of good news, actually, is that when a country goes into recession, what people stop buying is so-called durable consumer goods, cars. And if you have no car manufacturing in Lebanon, I think you don't have, then, well, basically the reduction of this part of consumption won't harm your country. You basically export part of the recession. And that's a benefit of actually not having this kind of production. What people really need is food, is services, and that's bought locally, which will then reduce the impact on the local economy from the recession. So half the reduction in GDP in Iceland was basically covered by a reduction of import. So the travel from Iceland abroad went down 70%. The camping in Iceland by Icelanders tripled. The only thing people bought more of imported goods was sewing machines, because everyone thought had to know how to make their own clothes. And then, of course, good news, the crisis hit in October 2008. In August 2009, 9 months later, there were born more Icelanders than ever before in the history of Iceland. So more people could help to pay the debt, basically. Or they just shut off the light and had to do what was free. Anyway, then there is, as I said, some import substitution and some export growth just based on the change of currency rates, and I think also that was touched upon this morning. There could be private funds that are frozen that you can reactivate and that can trigger new investments. You can mobilize private sector investment capacity. It has been mentioned, energy, renewable energy. That's the one sector where there are companies internationally willing to invest in, frankly, in almost any country. So if you really want to attract capital, it's the easiest arena where you can basically establish a policy and attract billions and billions of dollars of new investment that will help to solve energy security, that will create jobs, and that will also eventually improve the foreign direct investments. Then, of course, on the government side, you can implement some measures now that have an impact later, and so on and so on. So this fiscal adjustment, the external balance adjustment is fully possible, and the internal balance adjustment is also fully, but it takes a lot of dedication. Then you have currency control, and IMF has historically been against currency control, but in Iceland it was introduced, and that same scheme was introduced again in Argentina when Argentina got into a recent crisis. And it basically said that a wall is established in the financial market. You can go into the public kind of domain or to the central bank and get dollars or euros that's needed for imports of goods and services. that are defined and certificate, but you cannot get it to move money abroad. And that's most probably what you will also see here in Lebanon shortly. Then I will spend a bit of time on bank and bank restructuring. This is my specialty. I'm a European champion in restructuring banks. I put 20 banks into bankruptcy, and they all reappeared with a bright new future. Anyway, so this is what a balance sheet of a bank normally looks like in different categories. So basically, on one side, it's what the bank owns. So the bank, when a bank gives a loan to a company, that loan is owned by, of course, by the bank. If the bank lends money to your house, that's also owned by the bank, and then the bank often sort of loans money to other financial players, also to other banks. And of course, in Lebanon, from what I understand from the last presentation, a large part of that has actually been that the banks have lended money to the government to pay for one of the two twin deficits. So the bank's balance sheet basically consisted of these assets. Then it's what the bank owe, basically the claims or liabilities of the bank. One is in other countries, basically they actually have borrowed money from the central bank and not the opposite way around. Then you have the deposits from the customers, which of course is a liability of the bank, and market financing, which is basically that the banks goes to the market and borrows money in the market that's used to finance the bank. And as all the bright students know, these two lines needs to be of the same height. And then, as in the other country, the little blue part on the bottom here is the equity, which is the kind of total net value of the bank. So that was a 2-minute lecture on banking. And of course, what's noteworthy is how tiny the buffer is for normal banks. And why is that? Well, that's basically because the size of the equity is a cost of the bank. But that also means that as soon as that little blue part on the bottom is lost, the bank is in default, which means that the bank has a horrendously small, limited buffer, which of course is one of the reasons why when a crisis occurs, banks are the ones that are hit. So, what is it that you need to do if you have a banking crisis and want to resolve it? Well, either you have to increase what the bank owns, or you have to decrease what it owes. And there's lots of things you can do as a regulator in these processes. So you can basically, the easiest part is you can inject more equity, right? So you just put in more money and that solves the problem. But the blue one is so limited, so it doesn't really help. Then the government typically can inject more cash if it has money, but of course that's the problem here. The government doesn't have the money. Or the government, if it has other assets, that it can basically put it into the bank, and with that refinance the bank. And that's often coupled to a split of the bank. Then on the other side, you can basically write off what the bank owes to others. You can just say basically, okay, we know that in principle the bank is obliged to pay you, but sorry, it won't pay. So the first thing to go is the equity. You write that off. And I guess a speaker mentioned yesterday that it might be that the equity is lost. Yeah, the equity is lost. End of story. The second thing that typically goes is a part of the market financing, where you basically say that, okay, dear Deutsche Bank, you have borrowed money to these banks, or whatever, National Bank of Qatar or whatever, but that money isn't there anymore. So we have to take a haircut. And the third alternative, of course, is to go into deposit and basically declare that a part of the deposits is lost. And you can either just write it off completely, or you can say you can convert that into equity, which basically means that instead of owning a deposit, whatever, $1,000 in deposit, you own $900 in deposit and $100 in shares in the new bank. And if you do that, given the size of the yellow one and the tininess of the blue one, it doesn't really take a lot to solve a banking crisis through these measures. Personally, I think people are far too afraid of these kind of mechanisms. It's much better to go in and say, sorry, you thought you had 100 in the bank, you don't have 100, you have 80, but you own 20% of the bank. Then, of course, all bankers needs to lose their right, and the banks can then reappear in a new structure. And if you do, then you actually can get robust banks over a weekend, if this is just done forcefully. That was done in Iceland. The new banks were created out of the old ones. Not a single dollar was injected, but because of this balance sheet restructuring, these banks ended up being the most solid banks in Europe. And they can basically finance the entire rebuilding of the Icelandic economy. This is complicated, so on this you have to read my book. Working with IMF, and I will just take this one more chart. Of course, the priority number one of IMF, and I think this is going to be more and more important for you as time goes forward, because then you will see how this thing plays out. So, of course, the main concern is to solve the global financial system, and it's to protect themselves, because they also end up being a creditor. And they will depend on these so-called sponsor countries. But my view, they are in general well-intended. So priority one is to save the world. Priority number two for them is to save the country in question. So don't start to imagine that they aren't well-intended. They have showed a readiness to put pressure on the private sector clients or creditors. That's what happened in Iceland. 30 creditors came into the room, and I complained to the IMF about the central bank governor, who was a piece of shit, i.e. me. And the IMF said, just forget it, go, leave the room. He's doing what we think we should do together. Yeah. There's a lot of processes and systems that you will get aware of. And then, of course, my criticism would be, I think, mentioned by one of you earlier today, they have insufficient focus on growth, on what comes next. They have insufficient focus on what can be done by using market tools and so on. And then, to end perfectly on time, I think the call to action for everyone in this room and outside the room is this small chart that basically is a reminder. One thing is how you are hit. That is, of course, important. But most important is how you recover. And there are stories of countries that are, this is what happened for a number of countries before and after the financial crisis. Index 100, GDP. The US had a small boom, then was hit by the global crisis that itself created, but then came into a quick growth trajectory. The EU had a bit stronger momentum pre-crisis, a stronger crash, started on a good trajectory, but then got the Euro crisis, as we all remember, that basically led Europe as a whole to lose 2-3 years of growth, especially in Southern Europe, as they tried to sort it out. And then, for whatever it's worth, a small country, but still the largest crash, and then came back quite neatly. But then the one country that never was able to really fix the fundamentals, and still 20 years from now will fight with the creditors about who should carry the burden of the crisis that hit in 2009-08, namely one of the neighboring countries in the Mediterranean. So with that will be my final word of advice. Just get together, sort out what needs to get done, and get it done. Thanks for your attention.
Mr. Harald, we would like to thank you very, very much for this valuable presentation. And we can take, because we are running as usual out of time, we can take one question. Great. So more than one question. So who would like to start?
Thank you, Svein, for the presentation. I think one nuance between your comparison between Lebanon and Iceland is, in Iceland's case, it was much easier to default on your banks. It was much easier to make the banks default on the creditors because they're foreign. Whereas in Lebanon's case, the creditors are Lebanese. So it's much easier to basically piss off the Dutch and and British creditors over pissing off the Icelandic creditors. So let's say you were in a scenario similar to that of Lebanon, where actually your creditors are not Dutch, they're not British, but in fact, they were Icelandic. How would you deal with such a scenario? What message would you tell to your Icelandic creditors? Thank you.
Yeah, firstly, there's another nuance that you didn't mention, and then it's who are the creditors? Because in Iceland it was private money to private companies. So basically, a German bank, Deutsche Bank, had borrowed money to Icelandic banks, and that's a commercial to commercial, and there are procedures for how to do it. I think in Lebanon it's a bit different because I think it's partially private to private, but also the government sort of is behind it, given the link to the central bank. But I think the answer isn't that different. In the end, there is a bill to be paid, right? And the bill is there. It's sort of, if you go to a restaurant and we have a nice dinner, and then we end up quarreling, and there's a bill to be paid, the bill doesn't get smaller if you beat up each other and ruin the restaurant, right? It's exactly the same for a country. There is a bill to be paid, and the bill is linked to the historic restructuring. We can hate it, and we can think it's unfair, but it has to be paid. And I think the fairest way to do it, in my view, and I know that's a provoking thought for many, would be to wipe out the equity of the bank owners to convert what needs to be converted of the claims on the banks, including deposits, and say, okay, we will give back in cash as much as we can, but whatever is in addition, well, that's equity. And if the value of the economy re-emerges, then the value of the equity will also re-emerge. And I think if it's done correctly, I think it's actually surprisingly how smooth such a conversion can be.
Thank you. Another question? Yes.
Thank you, Mr. Øygard. If I'm in Lebanon and I want to buy your book, I cannot buy it because I don't have a credit card accepted on Amazon. My question is, if the regulators and the government is part of the system and in collusion with the bank owners, how do you deal with it?
There I will build on the last speaker. I think you have to separate the roles, right? You need to clarify the roles of the different participants in the kind of financial system. There needs to be a regulator, and the regulator should be independent of the central bank, and the regulator should only be focused on the integrity of the financial system. There needs to be a central bank with an independent central bank governor, and the central bank governor should be focused only on the stability of the monetary system. And there needs to be, of course, a government, and the government needs to be able to pay for its own activities. And if not, it either has to reduce its spend or increase its taxes. So there needs to be and lastly, of course, there needs to be bank owners that are credible bank owners and that are able to fulfill their role in a good way. So this clarity and transparency, I know it's easy to say, but again, that's the way to do it. And it's not really rocket science. There are small countries with relatively sophisticated financial industry that has done this, but of course it's a journey that you have to embark on.
Thank you. Yes.
Thank you very much. Thank you for the fascinating model you're proposing for application to the Lebanese economy. I have just one remark. This model is based on the assumption that politics is not playing any role in the reform. So, on the basis basis of what you have learned in the last couple of days here about Lebanese politics, would you be willing to introduce certain changes into your model? Maybe not right now, but in general. Thank you.
These elements that I outlined, right? This is the, how would I phrase it? This is the customary way to solve it, right? And if you want to solve it in a customary way, that will help to resolve things in a speedy manner, and that will reestablish your country and your economic system among the countries in the open market economy, well, this is what you have to do. There's no alternative. And that is irrespective of whatever politicians that are in power. And if the policy part of it isn't solved, well, then you end up with a lower blue line, right? So it's a call for action for everyone in this room.
Yes, Mr. Bifani.
Very quick ones, if you don't mind. First, how did you deal with the vulture funds? And second, but I know it's not really in the midst of the story, but what kind of safety nets were introduced to accompany the IMF program and the reforms you just highlighted? For the people, for the most fragile parts of the economy.
Okay, so I love the vulture funds. They're just fantastic. And why is that? Well, because when everyone else gets scared and afraid and run away, they are the ones that reappear. So I showed you in one of the banks, the value of the loans given to that bank was set to 3%. That loss from 100 to 3, that was carried by, to put it simplistically, by German savings bank. And if the German savings banks had been in the room in the restructuring phase, they would all have been thinking about their loss from 100 to 3. And that would be a messy, sitting there with a big group of German savings bank. What happened? Well, they all sold out. And they sold out to the hedge funds. And the hedge funds bought at 3. So instead of having a bunch of German savings bank sitting in the room creating problems, as they were thinking about the 97, the room was filled by commercially oriented vulture funds that had bought at 3 and wanted to get out at 6. So if we could do anything that could restructure the economy, that brought the economy back in life and restored some value, those guys would be super happy. And by the way, because the losses they had already written off were so immense, that provided funds that actually could be used partially to solve the other problem. For example, arrangements were made that foreclosures were not permitted, right? So the indebted households, they could not lose their houses because the banks were prohibited from doing foreclosures. And how could that be done? Well, that could be done partially because the banks were owned by the vulture funds. So bring them in and get rational players on the scene. And I know this is very provoking, and you can argue against it and on so and so and so, but that was the specific experience from this case. And it's often so. You need to have people in the room that are rational, that can think about the future, and that really can address the issues at hand, as opposed to bringing with you the entire history every time you start to open a debate.
Thank you very much.
And I will give a special offer if you don't have the credit card. And everyone else. I'm sure together with the Norwegian Embassy, we can find some arrangement.
Thank you very much, Mr. Harald.